Let's look at an example of recording the issuance of stock and Treasury stock transactions. Turner Corporation has two classes of stock authorized: 6% $10 par preferred and $1 par value common. The following transactions affect stockholders' equity during its first year of operations. On January 2nd, they issue 10,000 shares of common stock for $20 per share. On February 6th, they issue 1,000 shares of 6% preferred stock for $13 per share. On September 10th, they purchased 2,000 shares of their own common stock for $40 per share. On December 15th, they resell 1,000 shares of Treasury stock at $50 per share. We are going to record each of these transactions. So first up, on January 2nd, they issue 10,000 shares of common stock for $20 per share with a $1 par value. So the cash is going to be the 10,000 shares at $20 per share, or $200,000. The common stock will be the 10,000 shares at $1 per share, or $10,000. The additional paid-in capital will be the difference. You're going to take the $200,000 in cash minus the $10,000 in common stock to get $190,000 in additional paid-in capital. This is what it looks like when we issue common stock above par. On February 6th, they issue 1,000 shares of 6% preferred stock for $13 per share. It has a $10 par value. The cash will be the amount at which you sold the stock. So 1,000 shares times $13 per share is $13,000. The preferred stock will be recorded at the par value. So 1,000 shares times $10 per share is $10,000. The additional paid-in capital will be the difference. To determine the additional paid-in capital, we take the $13,000 in cash minus the $10,000 in preferred stock to find $3,000 in additional paid-in capital. This is us issuing preferred stock above par. Now on September 10th, we purchased 2,000 shares of our own common stock for $40 per share. So our Treasury stock is going to be 2,000 shares times $40 per share, or $80,000. This is what that's going to look like in the transaction. You're going to debit Treasury stock and credit cash, both for $80,000. This is us purchasing Treasury stock. On December 15th, the company resells 1,000 shares of Treasury stock at $50 per share. So note that that's $10 more per share than we originally repurchased it at. So the resale of Treasury stock, 1,000 shares at $50 per share, is $50,000. That's going to be our cash. Now remember, back in September, we purchased our shares of our own common stock at $40 per share. So we're going to recognize Treasury stock at that amount. So 1,000 shares at $40 per share is $40,000. The remainder will go to additional paid-in capital. You'll take the $50,000 in cash minus the $40,000 in Treasury stock to get additional paid-in capital of $10,000. This is us reselling Treasury stock above cost.